Today we're going to talk about common investment mistakes and how we can avoid these mistakes. This is especially important because this year we saw a return of volatility to the stock and bond market after many years. Volatility is often called a fear index because it is the value of your investments basically moving up and down, and the more it does that, the more it scares investors. So we need to learn to cope with this level of uncertainty. Here's a 10-year chart, and basically you can see that volatility has been very, very low until recently, and this year we've had two events, quite dramatic volatile markets. And investors should get prepared for more of that in the future. There are 5 mistakes you can recognize and learn to avoid. The first is making emotional decisions. Investing is not a race, and investors should take all the time they need to consider all aspects of an investment. The solution is maybe also to buy part of an investment and then buy another part at a later date once maybe things become more certain. For example, after an earnings announcement or after maybe a central bank makes an announcement. That way you can kind of diversify your risk a little bit. Second mistake is investing in a company or an industry that you're not familiar with. In this case, really you need to do your homework. Analyze the opportunity and, more importantly, the risk. Because the risk is what's going to determine whether it's a good investment in the long run or not. Third mistake is lacking an investment strategy. This investing really requires considering your objectives, how much risk you want to take, how you want to diversify, what your cash flow needs are, and also in the future what your cash flow needs will be. So you need to develop a strategy and stick to it. There are many templates you can get from a financial advisor or a bank where it will help you consider all aspects of your plan, and then you need to stick to it. And this includes rebalancing. Here we're going to show you a chart basically of different asset classes, and what you'll notice is each one of these is a different type of investment. Some are real estate, some are small cap stocks, some are bonds. What you'll notice is that they're almost never the same investments along the top and almost never along the bottom. That means that the best performing asset classes are never going to be the best performing asset classes year after year, and they'll be replaced by something else. So you need to rebalance your portfolio regularly. So just remember to sell your winners and also sell your losers and put that money to work maybe in the next best investment idea that you might have. The fourth mistake is that people more than ever have access to information. However, sometimes people depend on unreliable, misleading, or perhaps even misunderstood information. Investors need to be really careful, especially when they're using the internet as their source. The way the search engines classify your searches is they look at what you've done in the past for searching for subjects, and they'll give you more of that. So perhaps what you need to do is you need to look at a different kind of investment because maybe things in the market have changed. Maybe it's something new that you've never looked at before. And if you just look on the internet, perhaps you're not going to get the full picture of what you need to invest in. So the last mistake is following the herd. Investors need to avoid the pitfall of the herd effect. While it feels safe to be investing and following other investors in the same types of investments, this doesn't really reduce the risk. Think of it this way. No matter how many people make the same bad decision, it's still a bad decision. In fact, it makes it worse because when the herd stampedes, everybody loses. So what you need to do is you need to tune out the daily noise, the headlines, and do your own fundamental research. Have a variety of sources and ensure that you have a balanced view. I hope that you found that interesting. The 5 key mistakes that investors make are common to all of us. Perhaps you recognized some of those and maybe you've even made some of those in the past. But going forward, hopefully this will be helpful for you to make better investment decisions.